Let's talk about liquidity. Basically, liquidity is the degree in which we can recover cash from our investments if we have to or when we want to. This is the Investopedia definition of it, and I'd encourage you to go to Investopedia and other sources like it to learn more about liquidity. But in a nutshell, think about this spectrum. On one end of the spectrum, things are very liquid or easily converted to cash, and on the other end of the spectrum, it's the opposite, right? Things are deemed illiquid or very hard to recover our cash. So when we look at investments, there is a happy medium here that I'll get to called passive income. So when we look at our investment strategies, if it's really, really important for us to maintain a very liquid position, we want to invest in the public markets. Public stock exchanges are where we can buy and sell stocks on any given day, and it's pretty quick to get our cash back. On the other end of the spectrum, equity investments in private companies, where we're buying shares in a private company, or we're investing in something called a safe, and there's other information on our website about safes. So these are equity investments where we've got a percentage ownership in the company in return for our dollars that we invested. But these are very illiquid investments. Why? The company has to be sold to create the cash to pay back the shareholders. Therefore, it's very illiquid. So if you are going to make one of these investments, just be patient, knowing that you may not have any influence on when the company's sold or if it's ever sold at all, quite frankly. And in the middle, we have a bit of a happy medium. We have private debt investments. And some of the most popular choices today are the two that you see here, a revenue share agreement or a small business bond. But these are debt securities. So when you invest in private companies in a debt security, you're actually not having to wait till the company's sold. The company is obligated and committed to paying you back over time through its operations, and then you as a provider of that capital receive your money back incrementally over time, and that can create some passive income for those of us that want more of that in life. So that's where it sits on the liquidity scale. Important thing to know here, folks. So depending on your own strategy for investing in companies, you really got to think about how liquid you want your investment to be. Hopefully you got something out of this. See you in the next short.